Welcome to the Media Roundtable Special Edition, where we dive into the secrets of the craft and provide our perspective on industry topics in service of marketers responsible for the success of their audio program, the Chief Audio Officers. I'm your host, Giles Martin, EVP of Strategy and Insights at Oxford Road. Today we're diving into The Sound of Growth, a new case study from Oxford Road on how audio fuels branded search. We're going to be looking at how audio, podcast streaming, and radio impacts consumer behavior, and specifically how it impacts their searching for brands online. What we're finding with the analysis that we're presenting today is audio investment is driving almost around 20% of clients' branded search traffic. And that's based on hundreds of millions of dollars of spend across clients who've been running campaigns in audio for sometimes years at a time. We're looking collectively at over 30 years worth of media spending here. So we're looking at not just the immediate effects of search as well. We're also looking at some of the delayed impacts, some of the lag impacts, the value of consistent investment in audio channels and how that benefits brand search, and strategies for optimizing diminishing returns. And this, I think, can help us and our clients and our chief audio officers out there, bridge gaps in attribution, improve their thinking about brand awareness and flighting, and also, looking at the full funnel obviously is increasingly important to so many clients and marketers out there. So we're offering a lot of actionable steps today. We hope that will help clients and audio prospects harness its underestimated power. So I'm delighted to say today I'm joined by Tucker Peleuses, who is the VP of Strategy at Veritone One. Welcome, Tucker. It's great to have you here.
Thanks. It's great to be here too.
And many of our listeners may know, obviously, Oxford Road and Veritone One in the process of a merger. And it's the first time that I have been joined by Tucker on the MRT. And so we're really looking forward to hearing some of the Veritone perspective today. And then also I've trusted a familiar voice on the show, James Ingrassia, EVP, Head of Client Services at Oxford Road.
Hi, glad to be here.
Thank you, James. Thank you, Tucker, for joining the Media Roundtable. So let's get into it today. First of all, we're going to look at the immediate effects of audio on branded search. And the summary here really is that we see very consistently audio having a very clear, measurable impact on search volume. And for the slightly more, statistically minded, what we're really looking at here is correlations between audio spend and branded search volume, as given by Google Trends. We looked at different potential sources of search volume, but we've used Google Trends in the end to provide that apples to apples consistently across all of the clients that we've looked at. And as many of you will know, correlation is not causality, but what we see here is such regular, consistent relationships that it really, I think, gives us a lot of confidence presenting to our clients and presenting to the market to show how, audio really is producing these consistent correlations and these consistent impacts with search volume. And one of the main clients, you'll have a white paper that you will all be able to download soon after this episode, but we're presenting some data which just shows a chart of the spends going up and down in various weeks, and then very, very clear movement in search volume. As spend goes up, search volume goes up, spend pulls back, search volume pulls back. And I think one of the key things to mention here is we've looked at 10 clients initially for this initial report, and 8 out of the 10 clients show very clear, very strong correlations between their spend and their search volume. All of the clients, except for 2, have a statistical significance at practically the 99% level or more, and many of them are many more than that. And so I think intuitively, and then just from our experience, James, Tucker, and I, we all know that this is a real factor in the market. Our clients know this is one of the reasons why they spend on audio. James, Tucker, any sort of broad context that you would bring to bear to this conversation before we get a little bit more deeply into some of the nuances and some of the more of the meat of this conversation?
Yeah, I'm first too, for those listening along or watching along, if you want to see some of these graphs we're talking about, you can go download the report at oxfordroad.com/sound of growth, all one word, oxfordroad.com/sound of growth. But when you see the data, I mean, the data kind of speaks for itself when you see the correlation of audio investment and branded search results. And just speaking on behalf of some of the clients that we work with on the Oxford Road side, over the last few years, we absolutely see this as something that's really important because we've had a few instances, whether it was someone who went dark for 2 months and then their performance actually stayed consistent during that period because people were still remembering hearing the podcast and searching it up and going. But really more directly, we started doing some tests with some survey. How'd you hear about us surveys, adding a second layer to it when someone chose audio as one of the sub-channels, like where to hear about us. You could pick social, YouTube, Facebook, podcast, radio. If you chose podcast or radio, we worked with a few clients to get a second layer or a second question to pop up where you can auto-fill and auto-populate an answer to indicate exactly which show or which network or which streaming service you heard the ad on. And that really was a data point that plays into this case study here, because we saw over half of the people who indicated that they heard the client on an audio channel came in through search. So, for just using round numbers, if we had 100 people in 1 week taking a survey saying audio, 50 of them came in through Google or Bing or whatever search engine it was, which is just a testament of why you need multi-touch attributions here. Because if you're just relying on final touch, you're going to give that to search. If you're relying on survey, you're just going to give that to audio, but you kind of everyone kind of helps each other raise all ships, or whatever that saying is. But yes, so that's kind of what we're seeing on a very top level there with Tucker. I'm curious to know what you've seen on your side.
This comes up all the time. And I think, Giles, I was totally with you on the correlation may not be causation, but we're constantly thinking too of anecdotes are not data. But we have so many anecdotes about this where the audio spend has an impact on branded search. Like James was saying, clients will go dark and the branded search goes down. And you're like, well, you pulled back your audio spend. That's no surprise there. And so I know we'll get into some of the deeper ones, but this comes up a lot. And I think it has a big impact that if you don't address it at the beginning, you have a really hard time incorporating it into your models and your objectives and your CPAs as you go forward. And so I think it's an important conversation to get out in the open as early as you can with clients.
Yeah, and I think we've all known that it's an issue, and I think taking some steps towards quantifying it, I think and creating some rules of thumb that people perhaps can use or work towards as they get into the market and become more established. I think it can be really valuable for clients. And I think you make great points, both of you sort of alluding to issues around attribution. Because again, if you're looking perhaps at URL usage or promo code usage, you're going to miss all of that search volume, or that search volume. It may have a pixel that shows an audio touch, but it may have a social touch or a Google touch. If it's coming through search to your website, so the credit could be exclusively taken by Google in those types of cases. So there are many implications for attribution here, which are, I think, very important for clients. So I think the next thing for us to move on to, so we see that strong correlation between search and audio spend, the majority of cases. And I think one of the things that's really interesting here is we see those correlations get stronger and stronger as clients have more and more history with audio, whether you look at that in terms of the historical spend that they've had, or whether you look at it along the lines of the total number of weeks that they have been in the market. And so for clients that have a year or even a year and a half, like under 2 years worth of audio investment, those correlations tend to be weaker. But once you get to 2 years or more of audio investment, you see markedly stronger relationships between audio and search. And once you get to more than 3 years, you start to see really strong correlations. They actually weaken a little bit towards the very end as you get towards 4 or 5 years plus. And our hypothesis for that is that as clients have spent more and more on audio, they typically are spending more and more on other channels as well. And so the ability of audio to sort of stand out as a driver of those correlations on its own can diminish a bit over time. But I think that this is a really important point because we've talked about attribution, we've talked about setting expectations right at the start, Tucker, and I think that that's really important because you may have a brand that's new to audio, and we were talking with a brand from New York, James, when we were last there, who had been investing in audio really for the first time, and they'd been in for a quarter, and the results were decent, but not very, very persuasive. And so then they took some time off, and then they went back in later in the year for another quarter, and invested again. And again, the results were okay, but they were looking for some additional signals, inevitably to sort of help understand, how performance really is working. And they're looking at click-through rates in other channels, for example. They're looking at overall site traffic, but they're also looking for search volume and at the survey as well. They were using a survey-based method as well as a pixel to see how many people are saying, "I heard about you on audio." And some of these methodologies, they take time to build up. And I think that sometimes clients don't have realistic expectations around what audio can do in terms of the time scale that it operates in. Because when you really see those strong correlations build after 2, 3, 4 years plus of audio investment, it's because people have become accustomed to hearing your brand. The frequency has gradually built. And when they're working through their mental consideration set and they're finally in the market for a specific product or one of your products, that's when your brand starts to come to mind, and that's where that branded search comes into play. And if they get 1 or 2 ad exposures over an 8-week test or a 12-week test, that doesn't necessarily mean that you've won the battle for mind share that's sort of going on in their brains, that has been is the result of, in many cases, hundreds and hundreds of millions of pounds of advertising spending. So this is something that requires, or seems to require, investment. It seems to take time. And I think that is a really valuable piece of data that clients can take back to their managers or to their C-suite to show how this type of investment, like many advertising investments, it is an investment that pays back over time. Although it can pay back at the bottom of the funnel immediately as well, as we know. Any sort of reflections or comments on that in terms of your
Yeah,
experience? I know you've both been in it for a while with various clients.
I would probably say for our clients who are new to audio and testing it for the first time, this is something we always like to hammer home with that, because if you're brand new to audio and you are coming in, you heard that it works, or you're listening to your favorite podcast and you kind of want to be a part of it, you hear all the ads on it and you want your brand in there, you're not going to see results like in week 1 to where you need to be, because it's just not how the industry works, especially if you're buying baked in ads on podcast on that end. Because, I always use the example of asking our points of contact at our clients when it comes down to like listening to their favorite podcast. Do they listen the day it drops? And most of the time it's no. They accumulate a few, they listen when they can on the commute or on a run or whatever it is. And so if you have a major drop happening on a Thursday or Friday in a week and you spent a lot for that drop, you're not going to see the in-week spend correlation. But what you will see over time is people starting to attribute that, whether it's from a survey or a pixel, and that'll all come through. But most of the time, people, and it's just human nature. You can ask kind of anyone listening right now who's listening to this podcast, are you listening to this podcast with your phone open on a URL ready to go to a website? No, you're probably driving or walking or working, and then you'll remember something we may say, and you may go look for it later or search for it later. It's just human nature of how this all works. So podcast definitely has a lag time to show its true performance. I think one of the stats I've seen recently is 70% of your performance will come within 14 days of an airing on a podcast. And you have to remember, most people are probably not going to remember a URL. We did a whole white paper on that about how vanity URLs are kind of not the best benchmark for immediate performance, but people will go look and search for your product. And you have to be very cognizant of that and watch those trends when you have an audio campaign running. because if you see your branded search go up, it's probably not just from you spending more on Google or just those factors. It's most likely a correlation between podcasts, which we do show some great visuals in this white paper.
Absolutely, to all of that. I think there's a couple key things I think, Giles, you mentioned, like, you have an investment into audio, you start to see that build over time. A lot of people who are coming into the space for the first time are thinking about dipping their toe in. And so they're starting with maybe the minimum spend to get a read and expecting a huge impact from it. And I just don't think that that's the right expectation to have for it. You need to let this medium build. For what James was saying is totally true of, like, you're going to maybe hear this, you're on a second screen, you're not really thinking about it, you're not going to remember a URL. There are a bunch of things that make the channel great, but then there are also things that make it, that work against it. And so you need to give that listener time to sort through some of those things that are pulling them away from being able to activate through your means of tracking them on last touch. And so the ability to kind of let the channel build over time, you'll start to see that performance. And I think that comes into goal settings. I know that in here it's talking about, like, the value of, you're spending $1 in audio and you're getting a positive impact on another channel's dollar. So we've had conversations with clients to try and factor that in, where, you know, that New York client you mentioned, that audio just might have been like chugging along, not the greatest results. When we started looking at the branded search impact, you know, maybe the branded search got 20% more efficient when we started our podcast campaign. We've gone back to that CMO and said, well, maybe we should increase our podcast allowable CPA 15 or 20% to account for that. And next thing we know, podcast is now, quote, working, and we're hitting goal, and more placements are building. And next thing we know, the audio's investment is increased because we're hitting more goals with more placements, that then circles back and even further positively impacts branded search. So you start to see this. We talk about 360 campaigns a lot, but it's usually 360, and then it's just the sum of 12 parts, even driving 30% of it. But this is an opportunity to really find synergies between channels, and they both can grow simultaneously.
Yeah. That would be a really interesting sort of next step for this project, potentially, is to look at, you know, some of your additional data that you guys bring to the table, and perhaps like look at how audio and YouTube, you know, work in synergy, and can we identify, you know, even greater impacts there, or even, you know, audio and video together. I think this is really important as well. It's worth mentioning because a lot of clients come to us having invested lots of money in search. And search is just one of those channels that is terribly attractive to marketers, particularly performance marketers, because the cost per clicks often look excellent. The conversion rates are good. The intent is often high, especially obviously with branded search. And so it's easy to just keep putting money into that bucket, you know, over and over and over again. But consistently, what we hear over and over again is that can stymie growth. Ultimately, you can start to see growth plateau, and you're not necessarily reaching people who may need to be informed about you in the first place, or may not be, you know, in the market even for your product, or may not even know about the market for your product. You know, with a lot of these new digital brands, disruptive brands, you know, many of them are creating new markets, and the audio spend is just a really excellent complement to that, you know, lower funnel harvesting, you know, dollar that the search dollars are the role that the search dollars are playing. And I want to touch on this impact, this topic of lag that you both mentioned, because there's another way of looking at it as well, which we also address in the paper, which is looking at the cumulative impact of the audio dollars on that search volume. And you also talked about it, James, with sort of, you know, people pulling back and going dark, and you know, you can see the volume start to tail off, but often it may not tail off immediately. Like, it may stay elevated for a few weeks potentially. And again, obviously that depends a lot on how much historical investment there has been. But so far we've been talking about an increase in audio spend in a given week and an increase in search in that week. But actually we see that you can look at subsequent weeks search activity, or you can look at multiple weeks of audio spending, and you will still see correlations consistently, depending on which way you look at it, but you generally will see different correlations regardless. So one of the things that we looked at was, if you're aggregating the spend of the last 2 weeks, the last 3 weeks, the last 4 weeks of audio spend, does that still drive or show correlations between search volumes, and that absolutely does. And one of the things that we see in there is for B2B brands that tend to have longer consideration cycles, and more of a considered purchase, those lagged effects seem to last longer, and the search volume will stay elevated after several weeks worth of high spend, as people have more awareness of the brand, and then that consideration process is ongoing. People will be searching for a few weeks afterwards, whereas for business to consumer B2C type brands, it tends to decay a little bit more quickly. We tend to see more of a higher response to, or a higher search response in the sort of week or two following spend. And again, I think that this is really important, both in terms of clients' expectations, them setting expectations internally among senior marketing or the C-suite, and it's also important just for media planning, for flighting, for tactics. If you've got quarterly goals, and audio or offline is an important channel for driving the overall portfolio and driving the volume. If you're getting to 10, 11, 12 weeks into the quarter and you're looking to try and, turn on the gas in order to hit your quarterly goals, like, you may well have left it too late already by that point. Like, there's a big opportunity to make a difference, week 9, week 10, week 11 in the quarter, that by adjusting your flighting and increasing your spend, like, that can benefit you, for a month or more into the rest of the quarter. So, I think that that's just important insights for marketers as they consider that. Any comments or reflections on that, guys? Have you seen that?
Two on those. One of them being the point about the diminishing returns for B2C. I think the hypothesis is right that it drives maybe faster conversion. I also wonder if there's a sense of, like, when we think about the endorsement audio space, the first couple times you hear them, you remember somebody, your host talking about them, and you go to search. But after 3 or 4 touch points, maybe you're on for 4 weeks in a row. I wonder if there's also a second effect of the familiarity and then wanting to be part of the community of that endorser. So instead of going to search, you've now heard your person say it enough times, and you then want to give them credit. And so maybe then we figure the attribution gets a little bit stronger after that 4th week, which is why we see the diminishing return for B2C sales. That would maybe be one point. And then 2, what you mentioned about flighting, I think this is really critical of, we've done a couple exercises with heavy radio advertisers to figure out, like, this 2 weeks on, 2 weeks off, is that better than an always on approach? And what we found is, if you're on more weeks but less GRPs, you actually net a higher reach and frequency than pulsing up weeks. So not only you're getting more value out of the dollars you're spending, but then 2, we've talked to, this is more anecdotal, but talked to other team members who run different channels at those brands. And they've come to us and said, wow, by you being always on at the same spend, you've created this foundation for us to build on top of, instead of, it's really hard to go when we're 2 weeks on, 2 weeks off, and we pulse our spend back and forth. That throws other channels into a little bit of a swirl. And so you can think about the 360 approach, like, we have a foundation, they can build on top of that, and then everybody starts to kind of get more out of both of their dollars spent.
Yeah. And I think I can also, I mean, to your point too, Tucker, we had a client at one of our chief audio officer events in New York who made a comment, and they were with a global brand. They said that whenever they go dark on a channel for more than 5 weeks, they basically have to start over again on consideration and all that. So flighting is important, but same thing with just being always on at a lower GRP level is always important on the radio side. When it comes to our clients with D2C and B2B, I'd probably have to agree. I see that our D2C clients, they see a little bit more instant success, or maybe there's more correlation with timeliness there. But our B2B clients, depending on, I guess, the decision maker level, or how involved it is to convert your company to one of these clients, that often is months sometimes for some of the brands we work with. Or you spend in January, you may not actually convert them to a customer till the summer or the fall on that end, because it's a huge 6-figure investment for your company. Others that are maybe more instant, whether it's a job search or a website builder or something like that, those might be a little bit more immediate where you can test and learn and get a lead in on there. But I definitely see that as important to realize that B2B has a little bit more of a longer curve. And I think decision maker is also something to consider there, because how many times is there maybe a department head or someone who hears a podcast, and
Yeah.
instead of going to the site themselves, they may send a note to their team like, hey, team, can you look into this product? I heard it on a podcast. And now you've immediately lost all of your tracking, from pixel tracking to survey and all that. And branded search is really all you have to go off of
Yeah.
on whether audio made a difference there.
Yeah, and also, I mean, just one other thought on that, James, on those long consideration cycles. You are only really accounting for that initial action with your attribution and that initial search potentially. And if your team is all involved in the consideration process, and let's say that process lasts 3 months, think how many more audio exposures that people on that team may have if we're in, leading B2B podcasts, and the type of sort of halo, and it's not a word that I love in marketing because I think it gets a bit fluffy and it can be used quite ambiguously, but these trusted podcasts, trusted brands, trusted entrepreneurs who've been successful talking about your brand as your team is going through this consideration process. Like, that's only going to help even more above and beyond what drove the initial search or the initial response. And obviously there may be subsequent searching as well, which is sort of what we're seeing with our data. So
We saw a
uh,
huge impact of that in 2020 when brands pulled back
uh-huh.
because of the pandemic. And for the ones that stayed versus the ones that left, it was that, like you said, James, like restarting the machine, a
Yeah.
significant time lost of having to build back. That we saw a dip in their awareness because they weren't running, and then it was
Yeah.
slower to build than when they had started their campaign. And so
Yeah.
maybe we won't have another pandemic, but in opportunities to stay always on, it's a lot easier to maintain than it is to restart.
Yeah.
And
Well, I mean,
that
and
always on strategy too, sorry, Giles, is
go ahead.
interesting. We've had a client or two where they have a parent brand, but that brand has subsequent products. And so they kind of, everyone knows the brand name, but they went on in the spring with one product and then didn't return until the end of summer with another product. And, it took the same amount of ramp up time to go there. So we're in discussions to have that always on at a small pulse, just to kind of get that name out there consistently. And then you can always swap in sales messages or product launch messages on that end. But you kind of keep the cadence of not having to rebuild your engagement levels every time.
Yeah, and perhaps we'll circle up on this again a bit at the end when we sort of talk about search generally and sort of the role of audio generally for brands. That always on phenomenon, I think, is increasingly accepted and supported by data in the sort of broader marketing sort of universe. And it's a very important point. And I really like what you're saying, Tucker, about, the extra reach that's generated by, being consistently there, even if you're at a slightly lower investment levels, because you're reaching new people who are coming in and listening to different shows at different times, whereas otherwise you'd be having probably more repetition of existing users who are listening in a given moment in time. So if we have time for that, we definitely can circle back on that. One of you mentioned diminishing returns. Obviously, it can be connected to lag in the sense of sort of a decay in response after the initial weeks spike or peak. But we did observe diminishing return patterns in the data for a lot of our clients, where it's really very clear, like with lower levels of audio investment, and this is for clients typically who have been in audio for several years, but where they have been lower in their spend, whether that's earlier in their journey in audio or weeks where they've been pulling back, the search volume tends to be significantly lower and it ramps up quickly as they start spending more. And then once the spend reaches a certain amount of weekly volume or monthly volume, it does start to plateau at a certain level. And obviously you have outlying weeks, you have, really, really high weeks and unexpectedly low weeks sometimes. The particular client that we chose to spotlight in the white paper here, you start to see much more limited growth in search once you get above, say, 800 to a million, 800,000 to $1 million monthly. And that's just for this particular client. Obviously, the patterns vary for different clients, but I think it was just important to highlight that in the report, simply because I think intuitively, given our experience and also for marketers generally, I think we expect to see diminishing returns. Like, you can't just keep spending and keep expecting more and more search volume, on a linear basis. Obviously, it depends on market conditions and seasonality and the appeal of the product and the audience and all that type of thing. But we know that typically there's a response curve in terms of whatever it is you're measuring, whether it's revenue, sales, traffic, those types of things. So it felt validating, frankly, I think, looking at the data as a team to see those types of patterns. And, we've showcased some of that here as well.
And I think too, Giles, you bring up a really good point that the client we use in the white paper, one of those charts, $800 to $1 million a month is a very healthy audio budget to have as well. But I do think for those who are just testing into the medium, want to kind of hammer home that you don't want to just use branded search as your only metric there, because most likely if you're only coming in with $75,000 a month or $100,000 a month in podcast spend or even streaming, you're probably not going to see too much of a lift in branded search on that end, which is why we rely on the pixels and the added second layer of the survey on there to help tell the story.
Yeah.
Depending on how you're buying, though, if you're buying 5 radio markets and you're spending all that in those markets, you could definitely see some lift from your baseline search. But I do just want to note that to test into audio properly, you do need to take a chance. And I always kind of tell some clients, like, it's like swimming past the breakers in the ocean. Like, you get to toss back and forth a lot, but once you kind of get to a spend level, it's smooth sailing past the waves there, and you don't have to deal with too much turbulence in that regard. So it's something we want to see, but you're not probably going to see a big branded search jump from a $50,000 podcast campaign in a month.
Yeah, I think you hit on a really good point of thinking about what you want out of the channel. There's things that the channel can do. There's things that you want out of it. There's things that you think it should do. You might come thinking it's a CPA driver, and we're finding here that there's an impact on branded search. Maybe you hit, your cruising altitude or diminishing returns at, $1 million a month in spend, but then you look at, okay, well, over time, what is this doing to awareness? And so I think it's important to think about what's your primary metric that you want out of the channel, but know that there's these secondary things that it's going to do for you, and try and factor that in to your overall kind of like performance of what you think. I really liked in the paper that's like, it's performing or it's not by a CPA, but there's so much that can go into an actual performance of it. I really like that part, that there's more than just your primary.
Oh, I was going to say, we're just dealing with another instance where we had a client come in and they had a brand budget and a performance budget to go there. And it was really interesting because it's tough in the audio world to kind of say what's performance and what's brand, because technically it all should be tied back to some kind of performance. But we actually found that the brand budget, which typically was higher reach, non-targeted shows that we bought, performed really well on a performance level. So not only did they just reach a lot of people, the performance was there. So we had a really great discussion with that client to say, all right, let's actually convert these shows to your performers. And now let's go find some new awareness drivers that we're going to kind of do more long-term and actually study the effects on them through some of our partners do offer some brand lift studies and things like that. But it's not all the time you see that. Typically, if you go larger reach and all that, the performance may not be exactly where you need it. But for this one, it was a very interesting line where it's like, well, either A, you combine your budgets into one, and we kind of know that we're reaching people for awareness while getting performance, or we test the budgets, and if it performs, that all those shows go into that performance budget. So it's an interesting dynamic, which I haven't seen a lot. So it may just be a one-time thing.
You're not alone. I've seen that, and they give us 2 budgets, and you're like, well, we're going to buy the same shows. We're just going to look at them differently. And so we've had similar conversations with that. And it's about how do you want to tag? And it usually comes from different teams. And so then you have to get them to work internally to be like, well, how do you want to tag this? We're going to run the media to best support your business. You guys kind of figure it out internally how you want to allocate it.
Have you ever heard of any of these companies? Shopify, Bayer, Oracle, Indeed, Masterclass, Babbel, Tommy John, LegalZoom, Constant Contact. We could go on, and we could go on so much further now that we're joining forces with our friends at Veritone One. We have created the world's largest specialist agency in audio and in podcasting. Nobody's ever done anything like this before, and it's an exciting opportunity for everybody involved. What we do at this agency is we offer comprehensive services for brands that are looking to break out and be successful in this space. We call you the chief audio officer because we believe that what you need requires real specialist work. And the way that we approach it includes proprietary methods in media planning and buying, analytics and attribution, insights. We have a proprietary process called audiolytics, which is our trademark method for creative development that allows us to score ads for their persuasiveness. Audio isn't just the work that we do, it truly is our passion, and we aim to elevate this industry to new heights. And that's why we're the leaders in brand safety and suitability, as well as in volume in the space. We try to provide solutions that ensure that your ad buys align your values that you have as a brand with your business metrics that you need to be successful. This stuff is hard, but we're here to make it a little bit easier for you. And if you're a chief audio officer seeking best in market performance at maximum viable scale, please get in touch with us. Do the right thing. Go to oxfordroad.com. And if you're passionate about audio, if you're strategic, if you're relentless, and you're looking for a career change, consider joining our mission as an agent of influence. Send us your resume through our website, oxfordroad.com. We made it really easy to spell. Sign up for our free newsletter, The Influencer, and be sure to mention that you heard about us right here on the Media Roundtable podcast, because attribution is important. Thanks, everybody.
So these are such important points, and I think the way I hear it, you guys are both sort of making the same point in different ways, or different variations on the same point. But I think let's just be very crystal clear also with our listeners. First of all, like, most of our clients, they're performance clients. We're looking for a cost per acquisition goal, or a cost per lead, or whatever that cost per goal might be, or a ROAS. And in many, many cases, audio does work at the bottom of the funnel to deliver that goal that the client needs, or gets very close to it. But we often don't focus so much on some of these ancillary benefits that audio has, which can be branding benefits, even if it's not necessarily a big show, although it could be if it's very big property. But if you look particularly for podcasts, at all of the studies that the industry publishes about brand metrics, recall, favorability, consideration, intent, trust, like all of those metrics are pretty much off the charts relative to almost all other media channels. So the branding benefits can be really, really considerable. And now we're showing the search benefits can be really, really considerable. So, this sort of reinforcing the point that you're making, Tucker, is like, what do we want the channel to do? Yes, we can focus on performance, we can focus on lower funnel, we can focus on acquisition, and yes, we want it to do a great job there and get ideally to 100% of goal, or maybe at least 80% of the way there. But if you're not considering some of the other ways in which the audio channels are working for you, you're probably missing part of the equation here, and you're probably not really doing the channel a true service if you're not thinking about attribution in that pretty holistic way.
Absolutely.
Which is really one of the reasons we've published this report. All right, we are closing up soon. Just a final data point that I wanted to highlight here is we've honed in on 10 clients here, page 8 of the report, and using the correlations that we've got, we've been able to quantify an estimate of how much of the branded search volume we think audio is contributing for each brand. And just think it's an interesting data point to showcase. There's quite a lot of variation in there. I mentioned at the start that there are a couple of clients where we saw low correlations and lower confidence levels. One client had very, very low confidence levels, and then the other one that was a bit of an outlier was sort of maybe 81, 82% confident. And some of those correlations are a little bit weaker. But so you have you have one or two clients where our estimates for the amount of search volume that audio is driving are pretty low. So let's say less than 10%, even probably less than 5%, definitely in one case. But on the other extreme, we have a client that is generating around 42% of their branded search volume through audio. Now, that may sound implausible to some of you, and I think it's really important always to consider the context, of course. And this was a client that was a relatively young brand with a great product that was really investing heavily in audio before it got into other offline channels. So really no TV spend at that time. And not a huge amount of digital spend either at that time. Like audio really represented a pretty outsized share of their overall acquisition budget compared to most of the clients that we work with. Whereas clients that have a significant amount of TV in the mix, or really, really heavy investment in social, for example, like you would expect audio's share to be smaller. But those are the extremes. I mean, I mentioned at the start that we see almost 20% of search volume in average across the data set that we looked at for this. It's actually 18%. We've got another client here that's around 35%, and then many of the clients are in that sort of 20% range, or 15 to 20%. So it's not an insignificant amount of volume at all. And again, many of these clients, they come to us because they're spending a lot of money in search, but they know that it's not really fueling the growth, and it's actually audio plus search or other channels that are going to drive familiarity and recognition and consideration plus search that is the right strategy. So just wanted to highlight that in the report and also on the podcast here. Any comments from you, gents, before we start to wrap this up?
Just one for me on the variance of impact on branded
Yeah.
search.
Yeah.
I think it comes down to two. I mean, you think about what the brand is even named. Like in the late 2010s, we had a lot of fun D2C startups that were coming that, remember when it was fun to just remove vowels from your name? That makes it really hard for someone listening to a podcast to then type something in where it's missing an A or an R or something, or has a U and an X. So we saw a huge impact for those brands that their branded search went way up. So I think that could maybe attribute to some of the variability well. And then I think you made a really good point about, I think about sometimes the dollars they spend in search are capturing, but not necessarily generating the demand.
Yeah.
And so the audio plus search is a really nice kind of symbiotic relationship that it can work together well instead of spending $2 to compete for the same.
I just also wanted to highlight at the end of our report here, we do talk very briefly about Les Binet's work about share of search correlating with market share, and particularly changes in search, share of search correlating with subsequent changes in market share. And if you're not familiar with that work, I'd encourage you all to take a look at it. Les is a very well-respected researcher going back to 2007 with Marketing in the Era of Accountability. And one of the great things about the share of search metric is it's easy to get using Google Trends. It's free to get, and it's something that you can track on a regular basis. So for clients who have the right mindset, an appetite to really look at their audio investment in that sort of holistic way across the whole funnel with a longer term view, that's exactly the type of metric that we like to track, and we would really enjoy partnering with more clients on in terms of building that sort of full funnel measurement scorecard. So it just highlights the importance of search. And again, I strongly encourage you to go check out Les Binet's Share of Search paper if you are not familiar with that. Tucker, has that come up at all on the Veritone One side over the last year or so since it's sort of become public? I don't know if it would have. Yeah.
Lots and lots, and thinking about, I think, the people in market right now versus generating that future demand, and how we think about those, and what do we think about how our spend should be focused on those. I think what James is saying is, like, sometimes people think about the converting market right now versus people who will be in market later. They change it to brand and performance. So you can name it a bunch of different things, but I think being there when somebody is ready to activate. Like, one quick side, because I know we're running out of time. we had a pharma client. Like, you either have a condition or you don't. But
Yeah.
being there for when something pops up for somebody, 10 years down the road, I mean, we were advertising to 20 to 30-year-olds knowing the condition might be in your 40s or 50s. Like, that's a very long life
Yeah.
cycle, and
Yeah.
dollars spent now may not pay back for them a decade, but
Yeah.
it's important. And this paper was a huge driver for us to kind of get buy-in for that for the higher ups.
That's an excellent point too. And whether you're D2C, you may not be in the market to buy a very well built piece of furniture right now after hearing it, but in 2 months from now, you may recall it and go search it up on there. Or like one of our consumer protection category clients, they're an amazing resource when you need it, or when you need it, it's almost too late on that end. So, but when there was an incident that happened over the summer, they had some of their best weeks, but it can be correlated to being in market all the time with a consistent message, because people, when they needed it at the time or want to look into it, they remember hearing it for months or even years before that.
I'd just like to thank you, James. I'd just like to summarize 3 or 4 key points, because we do want to leave our audience with sort of clear recommendations and action items that they can take away and use right away with their planning. And so 4 points that we would hit here in our conclusion. One is the point about lag effects. So do plan for lag effects when you're putting together your media plans, when you're putting together your quarterly plans, quarterly goals. Don't respond to a poor week's performance or a couple of poor weeks' performance in a knee-jerk type fashion. That is not necessarily the right way to manage your campaign. Things tend to move a little bit more slowly in the audio world, and everything needs to be considered as a holistic system. So we strongly encourage people to plan several weeks ahead, plan for lag effects, and you likely will have a more well-rounded and comprehensive approach to delivering on those quarterly goals. Consistency, we talked about that quite a bit. Audio particularly, but I think it's true really of all advertising channels, is something that benefits from consistent in-market presence. The Ehrenberg Institute have been very vocal about this. It's also corroborated by Les Binet's work and other sources. So a consistent in-market presence, that old narrative about going dark and then struggling to get the momentum going again, it's very, very familiar to all of us. I think brands consistently see that. So do be in the market all the time and know that that's going to benefit your brand. Over time, the benefits should increase as people become more familiar with the brand. And we know from this paper, search volume is going to improve over time as people become more familiar, and likely other metrics will as well. Finally, number 3, attribution. We know that audio has significant challenges in attribution. It's really important to consider that not all of your volume is going to be a last touch on a podcast and a visit to your website or a URL or a promo code that's been used. So if your search performance looks too good, well, maybe it is. And do consider how audio may be driving the performance of other channels, and work with your team or your agency to untangle those effects, because it can be done. And optimizing spend levels. We talked a bit about diminishing returns. We've talked about lag. There are ways to optimize your spend depending on what your specific goals are. Again, this comes back to Tucker's point and James's point about all the different ways audio can work, and identifying really what you most want it to do. If you want it to drive search volume, for example, we talked about diminishing returns curves and how they're relatively easy to identify. If you want it to drive bottom funnel performance, but search is also a secondary factor, it's perhaps looking at both of those curves in combination. So there are definitely ways to optimize your spend based on the data that we are presenting today. So, gents, thank you so much for your contribution. I wish we had more time, because I feel like there's a lot more that we could say about this topic, but I hope that clients, prospects will reach out to us to discuss more, because it's a topic that we just passionate about, and we will keep learning about. And We are going to be diving into more and more data on this topic, and hopefully we'll have other search-related case studies that we can, or white papers that we can publish, perhaps even later in 2025. So thanks again to our experts, Tucker and James, for joining me to unpack the study today. Thank you all for listening. We appreciate your attention. This podcast is brought to you by Oxford Road, where we want you to succeed in audio and to use influence for good. As members of the marketing community, we have the power to advance voices that don't just entertain, but edify, to build bridges across differences and preserve fair-minded discussion around the most important topics of our age. If you're a marketer looking to align your brand values with extraordinary business outcomes, reach out to our agency, Oxford Road, by visiting oxfordroad.com and subscribing to our weekly newsletter, The Influencer. We'd love to hear from you. If you have any feedback or suggestions, please don't hesitate to reach out to us at info@mediaroundtable.com. And if you haven't heard about it, I do have to give a plug for Stu's Ad Infinitum. Ad Infinitum is Oxford Road's audio creative focused podcast, and Stu Redwine is our VP of Creative Services. And I'd encourage you all to start at episode 1 if you haven't listened to it, to get a good understanding of what makes audio ads work well, what makes them perform, and how you can make them work better. In each episode, Stu and one of his guests break down real recent audio ads from top audio spenders across podcast, radio, streaming, and even Sirius XM. And they've had some phenomenal guests on the show who are really deep in the audio space or deep in the behavioral economic space, behavioral psychology space, really understanding how the brain makes decisions, how people are influenced often by subconscious motives, and how audio can really resonate with our brains, on all different levels. So very, very interesting content about creative and how we can make the most effective ads possible. So season 2 is underway now. Please listen wherever you get your podcasts. And finally, thanks again to our guests, but also to the team who helped put the show together. That's Caitlin, Haley, Bianca, Kyle, Ezra, Mary Jane, Everett, Neil, and the team at Podcast One. Get well soon, Neil. And as always, influence responsibly.